Now we got to move into Jedi Options. Tyler joins us each and every Wednesday and Thursday on the Halftime Report to break down markets and whatnot. And every Wednesday, we've been doing this segment called Jedi Options. And Tyler, you are an excellent instructor, an educator, teacher, coach when it comes to the options market, breaking down option principles. You write an option theory blog at Tackle Trading, and you very often do the option report on the weekend for tackle traders out there, the pro memory community. Today, Tyler, we were going to talk about earnings and the volatility build. And on Monday, Matt and I had a conversation on the podcast about the straddle and strangle strategy in relation to the implied volatility building. So we're going to set this up. We're going to have a discussion about it. I'm going to actually bring Matt in first on Jedi Options just for one simple question. Matt, why straddles and strangles right now at this time in the marketplace? Why is this something that we're paying attention to?
Well, you know, in both the podcast and the halftime report, we'd like to talk about relevant market activity, right? And right now, we don't talk as much about earnings because we're kind of through earnings season. And once you start getting into the zone of earnings where we're only talking about a few retail components on a daily basis, and we're not really talking about earnings collectively as market participants, it's really that time when the volatility build type traders, the long volatility type traders like straddles and strangles, it's in that zone where you should be looking at those strategies, because again, where volatility is post earnings is you get the volatility crush. I'm sure Tyler and you are going to talk about that here in just one moment, but you get that volatility crush, and that takes a few weeks for it to kind of settle down and simmer out and get back into those historical lows. And as volatility comes down, obviously the net value of options come down as well. And so that's when you're looking at taking advantage of low volatility and trying to look at but bi-directional type strategies like V-shaped risk graphs like the straddle or the strangle. And so this is just an appropriate time to start looking at those types of volatility build strategies. And obviously the straddle and strangle are two of the better strategies to take advantage of that.
And they fall into the family of strategies we call Vegas strategies. And Tyler, we're not going to go through every single detail of how each and every component of the strategy works. We're going to keep it on a little bit of a high level. Then we're going to geek out on the risk graph and show people some of the minutia about how to model in time decay versus volatility build. Before we go into those type of details, though, can you kind of just explain your own interpretation or your own explanation of how volatility cycles work as they build into earnings and then they crush?
Yeah. So I got a chart of Nike up, and this is one of the ones we're going to emphasize for today's illustrations. But if you have the implied volatility at the bottom, and this is not IV rank, it's the actual implied volatility. If you look at that in combination with these earnings announcements, right? Every 3 months, every quarter, you've got these earnings announcements. And there's a relationship between the two that becomes very apparent as you look at this chart. But take a step back for a second. So implied volatility just tells you if options are cheap or expensive. And what we discover over time is it's relatively consistent, where they become cheap at certain times of the year, they become expensive at certain times of the year. And those times are usually around earnings announcements because of the uncertainty around earnings. And so one of the ways that you price an option, or one of the variables that impacts the price of an option, is risk or perception of risk or uncertainty. And when you look at when stocks are the riskiest, when there's the most propensity for change, it's around an earnings announcement. Because like we saw today with Dick's Sporting Goods, if these companies kill it, they get instant rewards. Their stock price goes up a ton. But on the other hand, if they whiff, they get smoked. And so in anticipation of that big event, people are willing to pay a lot for options. So options tend to get expensive. They tend to get rich right ahead of earnings. And after earnings, they get cheaper because there's less uncertainty. The market returns to normal. That catalyst is in the rearview mirror. And so conceptually, when you look at this implied volatility indicator, starting in, going into the June earnings for Nike, you could see you got a jump in IV, and then it got cheaper. And about halfway between the two earnings announcements, you'll see it trough. And so mid-July or whatever, Nike options are cheap. And then over the next 4 to 6 weeks in anticipation of the next earnings announcement, bit by bit, they kind of price options a little bit more expensive, a little bit more expensive, a little bit more expensive in anticipation of earnings. And then the cycle repeats. It drops, it goes up. So the latest one, which brings us to today's point here, last earnings announcement for Nike was mid-March. The next one's going to be mid-June. So we're right around that 4 to 6 weeks from the next earnings announcement. So the expectation, if past is prologue, if we continue this pattern, the expectation is this IV, which is low right now, signaling options are cheap, should start to increase over the next 4 to 5 weeks into the mid-June earnings announcement. And we want to try to build a trade around that exploits that build or that increase, that rise in implied volatility.
Wonderful. Matt, anything you want to add to that on just implied volatility in general before we get into a risk graph and start talking a little bit about strategy around this?
No, implied volatility and the build or the cycle between earnings is one of the more consistent cycles we see in the marketplace. And so traders do like to take advantage of it because of the consistency of the volatility build between earnings.
Absolutely. And, Nike's just a really good example of this right now, which is one of the reasons why we're bringing it up, but it happens on almost all companies. You mentioned Dick's a minute ago, Tyler. I did want to highlight that. You'll see the vol build into a vol crush on Dick's. It happened literally just on the earnings report today. The volatility, even though Dick's had a great triple whammy, it completely blew out the report. Volatility has to come down after the event in anticipation. And if you've not yet listened to the podcast, I'd go back and listen to the conversation I had with Matt about that. I think there's some really good analogies he uses and explanations to help you better understand volatility building and volatility crushing. But today, back on Nike for a minute, we looked at a bunch, Tyler. We looked at Goldman Sachs. We looked at, Netflix, companies that are reporting in early July or late June. There's other examples, but I really like this one to stick with it. Many times in Jedi options, we'll compare a delta strategy versus, say, a theta strategy, or a vega strategy versus a theta strategy. And today, what I'd like you to do is compare more of the vega versus the vega in different ways we could build this and break it all down. So if you could explain some of that and start that conversation, I appreciate it.
Yeah. So the strategy that we're going to focus on is known as a long strangle. And essentially, right now, options are cheap. And so this strategy is going to consist of buying options, right? We're going to buy options because they're cheap right now. And we think they're going to get more expensive as earnings comes closer and closer, okay? And so you say, all right, well, when I buy options, they're cheap. How should I go about buying them? Well, if you were bullish on Nike, I guess you could buy a call option. If you were bearish, I guess you could buy a put option. But see, I don't really have an opinion on the stock. And what we're trying to do is we're trying to isolate and make a pure play on volatility. And it's not a pure play on volatility if you're doing a really bullish trade on the stock or you're doing a bearish trade on the stock. So to make it a pure play on volatility, we have to build what's known as a delta neutral strategy. So it's going to be, part of it will be bullish, but part of it will be bearish, and they'll kind of offset each other. So the structure of a long strangle is we're going to buy a call option and we're going to buy a put option at the same time. And it creates a bi-directional trade that is essentially delta neutral, but it's long volatility. And so if that volatility goes up, that's going to benefit us, which we'll take a look at here in a second. So if you go to the trade tab, this is where we can kind of figure out what are our options here. The earnings is May 24th. June 24th. June 24th. So June 24th is the next earnings announcement. So I got to buy options that expire after June 24th. The options that expire before June 24th are not going to participate in that increase in implied volatility because they're not there for the uncertain event. So that means you got to buy either a July monthly option or an August monthly option. And we'll compare, contrast the two today. That'll be part of the comparison here. Tim, if you're good with it, let's start with July. and then we'll compare it with August.
Yeah, we'll get to both of them. So either one first is fine with me. Now, I already know where I would prefer. I talked about it on the podcast. I would lean towards August, but I think part of the visual here and the opportunity we have to really teach Vega might come from that comparison between the two of them. Mm-hmm.
Yeah. Well, and that's one of the things, that's what helps you make better decisions, because there's going to be some trade-offs between July and August. There'll be trade-off in cost, trade-off in theta sensitivity. But so I'm going to go to July, and the stock is $137.50. It's smack dab in the middle of 135 and 140. Okay. And so what we're going to do is we're just going to buy the first strike out of the money on the put side, the 135. And then we're going to offset that by buying the first strike out of the money on the call side. Okay. So I'm going to buy the 135 put, and I'm going to control click, and I'm going to buy the 140 call option. And the reason it's a strangle is because they're different strike prices. So when you buy a call and a put at different strikes, it's known as a strangle.
Mm-hmm. So, and definitionally, a strangle is just two long options on different strike prices, a call and a put, and a straddle is when they're on the same strike price. But functionally, we approach them with very similar, kind of mindset, correct?
Correct. They're very similar. The logic behind one is the same as the logic behind the other. And the management's almost identical as well.
Mm-hmm. Okay, very good. So here's the July. We did the 135 put, and the delta is 41. And we did the 140 call, and the delta is 44. So the net delta is close to zero on that because they're offsetting each other, making it a delta neutral trade and more of a play on pure volatility building. Okay, very good. So what do we need to look at next here, Tyler?
So the best way to really get a handle on this strategy is to go look at the risk graph. And we're gonna basically do some what if scenarios. So the good thing about a risk graph is you're able to stress test the position. You're able to see visually what the profit, the loss, and then you can kind of manipulate it and get a really good handle on how the trade behaves. But at first blush here, the purple line is the trade today, and then the blue line will be the trade at expiration. So we're going to focus on the purple line if you want to project out how much you're going to make or lose today. But notice how it's a bi-directional trade. I make money if the stock goes up because of the call option, but I also potentially make money if the stock goes down because of the put option. So that's what we mean by bi-directional. Like ultimately, I don't care if Nike goes up or down. I just want it to go somewhere. I want it to move, because the more Nike moves up or down, the more money I make. So that is one variable we want. That's one of the bets we're making. It's bi-directional. But it's also long implied volatility, which we'll get into in a second. But let's start with how we lose money. Right? How would we lose money? What do we have to overcome to profit in this trade? And the answer is time decay. You bought an option, you bought a call, you bought a put. Both of those will lose value as time passes. And so what we could do here on the date.
Tyler, 1 second before you go there, I do want to just kind of try to throw out an explanation that maybe, and I think you did a great job of it, but risk graphs are complex, right? And if somebody's looking at this for the first time, like, what am I staring at? The pink line, and help me if I'm correct in stating this, that represents potential profit at different stock prices based on today's date, 5/26/2021.
Correct.
The blue line represents potential profit at different stock prices based on July 17th, which in this example happens to be the expiration for the option, the day after the expiration for the option, correct?
Correct.
Okay, good.
Yeah, so the stock price is the scale on the bottom. So as the stock goes up, we're moving to the right. As the stock goes down, we're moving to the left.
Mm-hmm. Okay, all right, go ahead and continue.
All right, so as time passes, this blue line is not going to change because that's at expiration. It's the purple line that's going to change as time passes. So what happens here, this is today, if I advance this thing to, remember, it has earnings on June 24th. Let's say I advance this to June 20th. The week of expiration, a few days before, the week of earnings, a few days before the earnings announcement. What you'll notice as I'm advancing the date is this purple line is sagging. It's coming down. And down is bad because you're moving into the loss zone over here. So you can see losses are accumulating. So if the stock doesn't move, see the current stock price is this dotted brown line. If the stock doesn't move, at all, and what is that? 24 days goes by, 3.5 weeks goes by, you would lose $300 due to time decay. Okay, so time is not helping us in this trade.
And what's the cost of this trade?
This is an $870 trade.
So if you play July and you hold the options into earnings from the theta decay, you will lose nearly a third or even a little bit more than a third of the potential value. If all that happens is the stock goes nowhere, volatility doesn't change, but time decay bleeds the options. So you do have that. That's the thing you're fighting against, right?
Yes.
Mm-hmm.
That is the risk. And so it's like Nike, I need you to get a move on. Like don't pull a Russell 2000 and go dead sideways for the next 3 months, please. Like, do something. And it will be frustrating, Tim, day by day by day. If I wake up and Nike's like doji, that's not ideal. I want the thing to move because I got $300. I got to offset one way or the other. Now, I could offset it by the stock price going up or down. And so if I look at this line here, again, this line is now June 20th. If Nike runs up to 150, I'll be okay. And if Nike drops down to 125, I'll be okay. But even if the stock doesn't move, the other variable is volatility. The implied volatility increasing could also help me. I could even make money enough off of the IV rise to offset the time decay, even if the stock doesn't move. So let's model that. So I've got this advanced about 3.5 weeks. I'm sitting in losing territory. So now what I'm going to do, we clicked on this cogwheel on the bottom right. I can increase the volatility. And what that is that's this implied volatility increasing. Right now it's at 26%. If this thing went up towards where it was after or before the prior couple of earnings, conceivably this thing could get up to 35, 40, 45. You could see a 10 to 20 point bump in the implied volatility as earnings approaches. I can model that in the graph. So I can go to this vol adjustment. If I said plus 10, that essentially would be the equivalent of this IV bumping from 26 to say 36.
Mm-hmm.
Right? And what you'll notice now when I did that is it wiped out the loss. It goes back to break even. Right? So let's do that one more time. If the vol doesn't change and 3.5 weeks goes by, you're screwed. Stock doesn't move. Okay. You're going to lose money. So what I'm hoping is that vol will increase incrementally, of 3%, 5%, 7%, 10%, or more.
Mm-hmm.
And essentially what it'll do is offset that time decay and make it where I, break even or even make money if the stock starts to move, or hopefully, Tim, this thing will bump 20% or something. And then I'm making money, even though I suffered 3 weeks of time decay.
Mm-hmm. So the volatility building can help you offset the time decay. And there's a couple of things in these assessments I do want to throw out there because I've been doing these for a long time, and risk graphs, you can geek out on them. And on the chart itself, Tyler, it looks like Nike could have a 20% implied volatility build, and run all the way back up into the mid 40s. When I personally model these on the risk graph, though, whatever the best expectation is, I always cut that in half, So even if theoretically we could get up to 40, 45, see this IV measurement here, and I don't want to go long, drawn out explanation of this. Those aren't the individual strikes that we're going to be playing. That's the average of all the option chains together as they're kind of lumped into one index chart for that option chain, right, Tyler?
Yep.
Yeah. So even though 20 could be in the cards, I would always cut it in half and set my IV build expectation closer to 10 on this one. Okay. And what you're seeing there visually, guys, is that you are offsetting the time decay. That gives you the potential to build it. Now here with July, I still prefer the August. And I think we got to, get the cross comparison. Before we go down the August route and look at two different expirations though, Matt, anything you want to add to the implied volatility conversation we're having here?
No, I mean, what you're trying to do again, and this is something you guys have discussed, I'll just bring it up again, is you're trying to offset the theta decay with the volatility adjustment so that you can make it a bidirectional play. And picking the right expiration date obviously is going to make a big deal there.
Mhm. So now let's do that. Let's pick the August. Let's model that separately. Let's talk a little bit about the differences, because the time decay potential for the July was about 30% of the value of the options that you were paying. You got to get the vol build to offset that. August, by going further in expiration time, we're going to have to pay a little bit more money, Tyler. But what does that do to the math in terms of changing the nature of the risk graph and the Greeks?
Yeah, this is a good illustration that you don't get something for nothing, right? So what am I getting and what am I giving up for going to August? Well, it costs more, to Tim's point. So the July trade was $870. If you go out and buy another month, it's going to cost you $11.25, right? So, whatever that is, 25% more, 30% more, whatever it is. So it's going to cost me a little bit more. That's what I'm giving up. I got to pay more. So what am I getting? Well, August options aren't going to lose money as fast as July options. So I'm minimizing the impact of time decay. And we can put more context around that. I can advance this to June 20th again. And you can see that the August strangle will lose about $200 over the same time frame that the July strangle was losing about $300.
Mm-hmm.
But it's, so you say, oh, dollar wise it's less. Yeah, but percentage wise it's less too. Losing $300 on the July trade, which was $870 cost, that was about 40.
No, you flipped the 34%. Yeah.
34%. Okay. With the August trade, I was losing about $206 on 1125. It's about 18%. About half, right?
Mm-hmm.
So you say, okay, well, I don't want time decay, that monster, to eat my option value. I'll minimize his impact by buying August. That's the perk, right? What's the drawback? Well, it's honestly, I would just keep it that simple. I would say pay more, less time decay.
Yep,
right?
I agree. So
but it's the same dynamic with looking for implied volatility to increase. And so if the stock doesn't move, 3.5 weeks goes by, I'm down $200. What do I need to offset that? Well, either the stock going up or down a lot, or give me that 10% bump in vol, and then I'm into a profit.
Mm-hmm. And if you notice that one there, that 10% bump in vol with the same time decay expectation actually keeps you in a profitable zone on your straddle if those mathematical characteristics do play themselves out. And you'll notice here, I mean, straddles are not home run swings, guys. They're actually very, very conservative strategies when properly executed, in my personal opinion. You're putting an amount of money out there with an edge in the market based on a characteristic that happens all the time. Implied volatility build, okay? You're trying to offset time decay. You've got to map it out properly. You got to assess the math. But even like a $200, $300, $400 profit on $1,200, we're looking at a nice little return there for a position trade. But Tyler, these aren't like double, triple, quadruple type of things usually, are they?
No, you'd be really lucky. So you have to have proper expectations, because if you overstay your welcome, if you're like, look, I'm shooting for a 40% return, and it never comes, like eventually you'll just give back the 10 or 15 or 20% return you had due to time decay. So yeah, I think 10, 20% would be more realistic base hits for this type of trade, but ideally based off of, having an edge and being a pretty predictable type of scenario.
Mm-hmm. And that one last point on the July-August convo, yes, going out to August cost you more. It reduces the impact of theta, but you can't just play that trick forever. You can't go out to January, because the implied volatility build within the cycle is within that 3-month window, Tyler. The option chains that are going to be impacted the most are the ones that happen, before the next earnings season for Nike in September. So in my personal opinion, August is the perfect whammy for that regard as well, because you can't get out past the next one and still have the same implied volatility impact.
Yeah, so one way to think about it is this implied volatility average or index that they're using is a 30-day time frame. So it's modeling 1-month options. If you overlaid an implied volatility chart of 90-day options or 120-day options, the rise and fall would be very muted. You wouldn't see much of an increase. You wouldn't see much of a decrease. It would be very stable. So the potency of the volatility cycle is highest in those one month, 2 month options. To your point, you go further out, and if you actually model the vol, it doesn't rise and fall near as much.
Yeah, yeah. Back on the risk graph, though, as we finish up the conversation, let's bring Matt back in here. Matt, thoughts on this Nike analysis and just the volatility build strategy around straddles and strangles in general?
And first and foremost, guys, thank you so much for the detail and geeking out on this strategy and really taking the time to, go through the step by step and assessing what that risk graph looks like. Option traders love their risk graphs, and sometimes when we start mapping things out, we don't understand the impact on all the Greeks. This is a really good case study in how those Greeks impact that strategy, what you're trying to accomplish, and how you're taking advantage of that implied volatility build by offsetting the theta, treating this bidirectional, and taking out that and taking out the risk, quite frankly, to both theta and direction here.
Absolutely.
Loved it. Wonderful technique, guys.